And a very pleasant Monday. Look who we have here, the president and CEO of the Mortgage Bankers Association, Bob Broeksmit. How's it going, sir?
Great, Greg. Thanks for having me on. How you doing?
I'm doing pretty well. Thank you very much for asking. I've got my new glasses on that my wife tells me make me look smart. I figured if I'm going to talk to one of the smartest people in the industry, I might as well try these out. This is the debut for these. What do you think?
I think they look great. I can't really see them because I don't have my glasses on.
My producer, Gene DiPaolo, says I look like his grandmother. So I don't know.
Well, you got that going for you.
Yeah, of course. Hey, nothing wrong with grandmothers. 3 weeks from today, we'll all be in Vegas. In fact, many of us before then. Empower is going to kick off again. What a fabulous event that is on Saturday. Marcia Davies will be ushering that in. And I know you're going to arrive probably that Friday, but tell us about it. How much are you looking forward to annual this year? It's a big undertaking, I know, and a lot of people behind it.
Yeah, it really is our showcase of the year, Greg, and really looking forward to it. We haven't been to Vegas since, I forget, 10 or 12 years. And I'm told, although I've never seen it, and our team, of course, has, that the new Fontainebleau there is really great and pretty self-contained, which is nice. Because one of the things sometimes people don't like about Vegas for a convention is all the toing and froing and trying to get across that strip and all that. But it'll be really self-contained, a great new facility. We signed the contract before it was built, and really excited to gather there and talk about some things that are actually going better in the industry for a change. So that's really exciting.
Yeah, what are a couple things you feel like are going well for the industry right now?
Well, the rates are near a low that we haven't seen since last fall. And when that happened last fall, we had a refi ripple or boomlet or whatever you want to call it. It was short-lived, but it was really helpful. And our application numbers indicate that refis are way up again. And I think the sentiment is much rosier just in terms of being able to get transactions done, and as maybe we'll talk about, the coming end of the trigger lead scourge. There's a 6-month implementation from when President Trump signed the bill recently, but that's got, I think, everybody optimistic that real pain point in the process has been eliminated.
Yeah, we'll definitely come back to that in a minute. I just want to talk about the headliner, former Treasury Secretary, Harvard President Larry Summers will be there. I can't wait for that. What a smart guy he is.
Yes, to me, it's a twofer because Harvard has been so much in the news with the litigation against the administration for cutting its funding. And so, of course, Larry Summers knows what it's like to be a president of Harvard, and perhaps more importantly for our audience, his long service as Treasury Secretary and an expert on all things economic, and pairing him up with Kevin Warsh, a former Federal Reserve Board governor and one of the at least rumored finalists for the Fed chair. And actually, as the date was approaching, I thought, oh, Lord, there's an opening on the Fed. What if the president appoints Kevin Warsh? He may not be able to come and speak because the Fed has those blackout periods. But frankly, I think he'll be able to speak much more freely and openly as a former and perhaps future Fed governor than as a sitting Fed governor.
Yeah, lot to unpack here, especially with the administration. We'll get into that in a minute. I just want to tie up the annual. It's in Las Vegas at the Fontainebleau, October 19th to the 22nd. And for those people watching this in the industry, who is annual for? Like, what is, I mean, it's not for everyone. Like, you don't want processors there, probably. They're not going to be impacted the way that a C-suite executive would be. Should originators go? Like, who is going to get value out of this tremendous show that you put on every year?
Sure. Well, we have great convening power at MBA, so the sessions will be great. But at annual, a lot of the action takes place away from the sessions, and it's just a great convenient meeting point. So certainly all capital markets and I would say sales leadership professionals should be there, because Fannie and Freddie will be there, and pretty much all the investors investors, all the mortgage insurance partners, all of the people that help make mortgages happen, including on the servicing side, are there. So it's a really efficient way for people to meet everybody in the ecosystem at one place and to have some fun. There's some great receptions and parties, and it is Vegas, so there's always an entertainment component to it as well.
Yeah, for sure. All right, Bob, let's dive into some issues here. I've got a nice little list to share with you. Well, let's start out with the administration. You mentioned the administration. Now we're coming up on a year-ish. 3/4 of the way through a year. I know it's a challenge. You have one administration that you're used to communicating with. Democrat or Republican, it doesn't matter. When there's a changing of the guard, there is an adjustment period that you have to go through as the biggest trade group in the industry. What has that been like? What are the lines of communication at this minute like for you guys?
Sure. Well, Greg, we've been really encouraged by a lot of the steps the administration has taken in the first 8 or 9 months with a very much a deregulatory bent. And there are things that we have been advocating for years to reduce complexity, increase efficiency. And we provided the applicable agencies, primarily FHFA, CFPB, and FHA or HUD, with what we call day one letters that said, here are things that are important to our industry and that we'd like you to focus on. And I'm really been delighted with the response and the real emphasis toward what can we do to make lending faster, easier, more efficient, and take away the burdensome regulations. That's not to say we don't want to be regulated. Of course we want, it's an important thing that this industry is regulated appropriately, but the checkers checking the checkers to avoid the liability that comes from some of these rules has just ballooned costs in our industry. So we have a very strong relationship directly at the top of those 3 agencies, as well as some of the other financial regulators. And while the approach has been unorthodox, I think it's fair to say, we really do like the direction they're going.
Yeah, so you talk about unorthodox approach. I think you might be talking about just using social media to make announcements, which, as a consumer, as someone in the mortgage business, it's been refreshing.
Yeah.
To see things real time unfold. Now, there are complexities too. It's one thing, as FHFA Director Pulte said, all right, we're open for business. We're taking VantageScore, for instance, right? Like that looks great and it excites the industry, particularly those of us, and I'm definitely one of them, that wants this competition in the credit space. I know you do too. We're about to get into that. But it's easy. It's one of those easier said than done things, right? It's not just an overnight switch. And so I'm guessing that is the gray area that sometimes creates more work than less. Unpack all that for me, and then touch on where we stand currently with VantageScore. Sure. And how long you think it's going to be.
Sure. So Director Pulte made this announcement and frankly took us a little bit by surprise. And he has a bias toward action, which I appreciate. There are complexities, though, in implementation. And we just needed to be clear to our members who were calling us and saying, hey, I had a loan officer see the announcement and he's pulling Vantage for a Fannie loan, and they're not really ready to accept it. So we put something out endorsing the move, very pro-competition, but then just laying out some of the issues that needed to be settled, like if you have loan level pricing adjustments that are based on FICO scores and you pull a Vantage score, how do you price the loan? And if you have a minimum FICO score, if you pull a Vantage score, what's the minimum Vantage score? And other complexities. But the good news is that the announcement lit a fire under Fannie and Freddie, and we've been working very closely with FHFA, Fannie, and Freddie to get all of these decisions made and communicated. In fact, I just heard this morning that Fannie and Freddie have released revisions to their MBS disclosures that will pave the way for VantageScore. So we see concrete steps being taken. And I think and hope that before the end of the year, we will actually have an operational system where lenders can choose either VantageScore or FICO.
Oh my goodness. Well, that'll be embraced, I think, by the industry, depending on a couple of factors. And here are two that come to the top of mind. What's the cost going to be? Like, are we about to pay more? Are we going to pay less? And then, of course, there's the great debate. And I know that MBA has championed this idea of not needing 3 scores. Like, maybe we just need 1 score. Maybe we do a buy merge. So that is one of the things that we're going to all be looking really closely at. What can you tell us at this hour about your progress there?
Sure. Our view is that while having VantageScore or FICO, and remember that the previous FHFA decision was never implemented, but decision was to have VantageScore and FICO, which we know would have increased costs, right? And my understanding is that the current pricing for VantageScore is identical or very close to identical to FICO scoring. That's not to say that with competition, they may not alter that and lower costs. I think they'd be crazy to raise costs. We'll see. But the broader impact will be changing the requirement, which we consider an outdated one, that you need a tri-merge on every GSE loan. And let me give you a few statistics, Greg.
Yeah.
The most recent quarterly release from Fannie Mae, for the loans they purchased that quarter, they had a weighted average credit score of 757. 75% of them were over 740, and only 6% were 680 or less. All right, well, if you have a 680, you probably want as much information as you can get, and a tri-merge probably makes some sense. That's 6% of what they bought. For 75% of them, they're 740 and above. So if you pull a single in file and you get a 742, what additional information are you getting from the other two? When we were younger in this business, Greg, and the credit bureaus had more regional differences, or there were more creditors that reported to 1 or 2, but not all 3, you could see wider dispersions in scores. But the data I've seen suggest that at the high end, you might have a 20-point dispersion. All right, so if you get a single in file and it's a 741, and if you pulled 3, the middle score would be 721, are you really going to change the loan decision? I kind of doubt it. So anyway, that's what we're thinking. And we think that would bring, well, we know that would bring competition finally into a space where the 3 credit bureaus have a government-granted oligopoly. And they behave as you and I would if we had that, and they raise prices, because why not? You got to use us. And we're sick and tired of it. And now we're sick and tired of being sick and tired. So we're moving, we're taking action. RESBOG, our Residential Board of Governors, has endorsed and promulgated an official policy statement that says that GSEs should move away from the tri-merge requirement. In other words, not require a tri-merge on every loan. And we'll have another meeting in Las Vegas, which will clarify what our recommended next state is. And maybe it's a waterfall, like I said. Maybe if you have a 720 or whatever the number is on a first in file, you stop. Maybe if it's below that, you move to a buy merge. Or maybe another one that I think is intriguing, Greg, is maybe you get a single in file, but you get the customer's permission to review your bank statement so that they can add that cash flow underwriting component. I know there's interest in that at the GSEs as a way to bring to bear rental payment history. You hear a lot about rental payment history, but very few landlords report to the bureaus. So even if you use VantageScore, you're not getting it in a very high percentage of the cases. But if you get 12 months bank statements and you see $1,250 moving out of the account on the 3rd of every month or something, guess what? That's a really important underwriting data point.
What's your quick, hunch on if we're going to, by the time this all shakes out and settles in, will we need 3, you think, or you'll get something less than that? Are you feeling good that it's going to be less than 3?
I am. And,
okay.
and some of the same people at Fannie and Freddie who need to work on implementing Vantage Score are the same people who would be involved in changing away from a tri-merge. So it is a sequencing issue here. We do need to get the Vantage Score implemented, but we've had very positive discussions, which will continue in Las Vegas with the GSEs and with FHFA on this topic.
It is complicated. I mean, let's be honest. I mean, and I've talked a lot about this. You've got FICO, which has their price, and they give it to the three bureaus, and then they increase that price, and then they hand it over to the CRAs, and then they increase that price. And making things even more complicated is the fact that Vantage Score, which seems like a viable alternative, is owned by the three bureaus. I mean, you talk about like a tangled web, but we've talked a lot about that. So I want to pivot into what you just made a comment about. Alternative documentation, should the score be below this, or should we use rental payments, or should we get bank statements? Some of that is like non-QM-esque. And I just have a question for you. I'm seeing non-QM. I'm hearing about the appetite on Wall Street to even pay up more than conventional loans. And it like got me scratching my head to say, this is picking up really, really big momentum. And are we going to look up and be in a situation where non-QM is 20%, 30% of the market? And is there any danger in that? I don't know. It just seems like when there's an all-out exuberance around anything in our industry, there's another side to the equation. What do you think about that? Do you ever think about another side to the coin, or do you think that non-QM is all the rage? Anything to look out for there in terms of a danger?
Yeah, I don't see it, Greg, getting anywhere near that market share that you mentioned. And let me just make a clarifying comment on bank statements. I'm not saying only use bank statements. I'm saying get the pay stub, get the tax returns. This is very much a QM loan. It's just that you can find out things from bank statements that help on a marginal file to say, hey, look, this guy's got a good rental payment history, and that's going to put him over the edge toward an approval. And it also would show, there's this whole issue about buy now, pay later, and more consumers using that instead of credit cards. Things like that can be underwritten better with bank statements, but I'm talking about that as a supplement to
of course.
Not instead. So anyway, on non-QM, yes, it's growing. I think it serves a market need, but it will, in my view, remain a small portion of the market, serving things like people who want to buy a house and fix it up and then sell it again, which some lovingly call fix and flip, debt service coverage ratio loans, investment properties, all those sorts of things. And if we are in a situation where the buyers of mortgages that are not government guaranteed have a good bid, hallelujah, it's better for the consumer. And now that bid will come and go in a way that Fannie and Freddie, are more steady. And that's the purpose of Fannie and Freddie, to be there in all economic conditions. And you do see more volatility in non-agency, but when the appetite is high and maybe they're buying and securitizing agency eligible things like high balance conforming, second homes investors, if the agencies have priced that in a way where a private execution makes more sense, then that's the market at work, and it's good for consumers.
Yeah, the reason I ask is because for us at NFM, we're doubling down on it, right? So we did $400 million last year. We want to do $1 billion this year. I know several other lenders, this is their number one priority. And so if everyone's thinking the same way and stacking and trying to double and quadruple, then naturally the market's going to see the results. And so you could look up and have a bigger number, and just the appetite around buying these is interesting to me. I think it's something to keep an eye on.
The only point I'd make, Greg, is it can't manufacture demand. So it may be that for you to double, you're going to be competing with others for a finite resource as opposed to the actual market increasing in size, because these typically are loans made to a certain type of borrower, usually with some sort of business purpose, even if it's an investor loan. So I think the competition will increase. The bid is there, but I don't think you can manufacture demand.
Yeah. The only disclaimer I'd throw in is that nothing prevents creativity around new products. So if you can imagine that the people eating up these loans want more of these loans,
Yeah.
obviously, because they're paying up for them. So, hey, what other alternative things can we build around this that can fit into non-QM? And, that you start to go down that road, right? And who knows? Maybe it dilutes the quality of the loans. I'm just saying something to look
I
at.
hear you. Yeah, no, definitely bears watching. I agree with you.
About a year ago, I got to see your handsome face there on stage in Denver. And you're an amazing speaker, by the way. If people have not seen you speak, it is a sight to behold. You are incredible on stage. So, kudos to you for that. About a year ago, you were talking about the idea of a housing czar, which is something that has been kicked around for several years, including by your predecessor, David Stevens. So I loved the idea, because you get somebody in there that knows housing, that knows the mortgage industry, and they're kind of a conduit between the administration and the MBA, and we can all work together. Are you still a fan of this idea? Are you satisfied with the lines of communication now, or is this something you'd still like to see happen?
We'd still like to see it happen, Greg. It I think would play an important coordinating role and give housing the attention that it deserves, housing and housing finance. We like in any administration, there are some inconsistencies between various departments in the administration in the first 8 months of this administration, just like in everyone. And we do think that empowering somebody with the housing portfolio across government departments is still a good idea. It would reduce conflicting signals that we sometimes get from the various agencies. And as I say, serve an important coordinating role and really put some meat on the bones to the campaign talk about how important housing and housing affordability is.
Okay. Foreign investors. This is something I've talked a little bit about, from quarter one. This was a report. 27% of homes bought in the first quarter were from foreign investors. 56 billion spent last year. 78,000 U.S. homes. I'd just like your opinion on this. I feel like we should have some kind of governors in place to limit the amount of properties, or at least make it more complicated, or impose some kind of a tax for foreign entities to be able to come in. I mean, we've got obviously a supply shortage, and for it to be a free-for-all when countries like China, I mean, it takes literally an act of Congress to get one property there. You have to live there for 12 months. You can only get one property. It's a leasehold, not a freehold. It just seems like these people that are coming in, these countries that are coming in, gobbling up our market, are smart enough to know that, hey, we're going to have limitations over here because it could affect supply. What is your opinion on this, and is this something the NBA would ever look at to try and push the administration to take a closer look?
Well, I think that with existing home sales bumping along the bottom at 4 million a year, I'm not sure how aggressive we want to be in turning away demand from foreign investors. And when I think foreign investors, and I'll get to China in a minute because that may be a different case, I think of Canadians who buy condos in Florida. I think of Venezuelans and people coming to buy, Europeans coming to buy places in Florida because of the strength of our economy and the relative stability of our currency, and we want to be a place that attracts international interest. I think it's actually good for the market, but there are real concerns, and not so much on the single family home side, but when China or Chinese entities buy up parcels near military bases and say, well, geez, I'm just going to grow some wheat. I don't know, that doesn't ring so true. And I know there are efforts in Congress to curtail that. So, but on the individual side, as long as they're underwritten well and we're attracting international interest to our market, I think ultimately that's a positive.
Yeah. Well, and there's some mom and pop shops too. There's domestically people trying to build portfolios. You don't want to. I mean, that's the flip side of the equation. And then people that don't like the idea of putting something in place would say that, and probably accurately, that during subprime, it was those same countries that came in during the crash that helped to stand it back up. On the other side, but on the other hand, when you have an all cash buyer from out of the country, plopping down, paying 10% above what the asking price is, it does a couple of things. It boxes Americans out. It also raises the price, right? So now comps are higher, which, what does that do? It makes it has a trickle effect and puts another dent into the affordability problem. So there's a lot of sides to this, and I appreciate your answer, and I understand it. Like, we want to have a healthy housing market, and to that degree, I think you need some level of foreign investment. I just don't know how much. Should it just be ungated? Yeah. Right now, it's currently ungated, so that was the only question that I had. A lot of consolidation going on in the business, right? You've got, obviously, I haven't talked to you since Rocket acquired Mr. Cooper and Redfin, and you've got Guild and Lakeview, and so there's this thing happening where it seems like the servicers are really making a play for the origination and vice versa, and they're not doing it because they want to stay at current market share levels. They're doing it because they see an opportunity to create what Varun Krishna talks about, and that's this flywheel where you can do more loans and be like one place for consumers to go. From the NBA standpoint, how do you see, what lens do you look at that from, and in particular as it impacts the smaller players that maybe can't service, right? You've got a lot of members. You've got thousands and thousands of members. There's only a handful of the bigs, right? Everybody else is down here trying to figure out what the future of the world looks like.
Yeah, I think that from time immemorial, which for me is 40 years in the business, the origination and servicing endeavors are complementary. And when companies get overloaded on one side or the other, they're not as well positioned when the market shifts. So having both originations and servicing and being able to do it at some kind of scale is clearly the play for the larger players. And once you get a certain scale, you want to get a little bigger. And but the reassurance that I would give to smaller lenders, either who sell servicing released, or maybe they use a sub-servicer because they don't service enough to really be efficient at it, is that they have withstood market changes for decades. That, I mean, the earliest one I remember, going back probably to the 80s, was when Sears owned Allstate Insurance, and it had a mortgage entity, and Coldwell Banker Real Estate, and it was going to be the one-stop financial shop. And I remember, Greg, our leaders at a small conference a couple years ago spending a lot of time bemoaning all the compliance headaches and the state regulatory exams. And I said, this is true, and this is why the mortgage business has not been Amazonified. So you remember, there was a time when we thought Amazon was going to come and really take control of our industry. So, or Walmart, financial superstore. So I think that there's a certain logic to the Rocket Mr. Cooper tie-up. And I think that it's also unusual for an industry of our size and importance to consumers, that even with that big tie-up, they would touch maybe 1 in 6 loans, and that may be overstated because that includes subservicing. So that leaves 5 and 6 for everybody else, and the execution is really where the rubber's going to meet the road. Now, those two companies are good operators, and maybe they have a better chance than most to make this combination work. But I'm really confident, having started at a small lender and worn some shoe leather, that they'll continue in a lot of cases to out hustle the bigger players, to provide the service and the relationship that most borrowers still want, and will thrive into the future.
Yeah. So there's room for everybody to win, is what you're saying. I agree with that. And I think I like it. I like Change is good. It's uncomfortable. And I think the rest of us are going to learn a lot by sitting back and watching these entities and where their successes are and where their failures are. And the one thing about Varun that I love is, here comes this person from outside of the business who opens up his playbook for everybody to see. I truly believe he's an all of us guy. And that's great for the industry.
And another plug for Annual, he'll be on stage with Bill Emerson at Annual in Las Vegas. So we'll hear all about it directly from the source.
Oh, excellent. And, I'm wondering at Annual, when do you start working on your speech? You have speech writers, Bob?
I do.
Excellent.
In fact, I have a great one who was Vice President Pence's speechwriter in Trump 1.
Who is that? What's that name?
Stephen Ford. Stephen Ford.
We're going to edit that. We're going to edit that part out.
Stephen Ford. How about that?
Let me ask you the question again. Yeah. Ready?
Yeah.
Who is that?
Stephen Ford. He's really talented. And the answer to your question is that I do my speech closer and closer to the event compared to years past because things change so quickly. So I have a lot of ideas in my head, but I haven't looked at a first draft yet.
Yeah. Last year was Katy Perry. Stan Middleman, man, can he throw a party? Love that guy. Love his energy. Love what he gives back to the industry. He's so iconic in my estimation. He just threw a lot of lifelines to many of us coming out of COVID and the slowdown when he bought our books. So to me, that guy lives in rarefied air. This year, One Republic. So, I saw your moves last year with Katy Perry up there, and you were really dancing. You let your hair down. Are we going to see a similar thing from you with One Republic?
Well, yes, in short. And we have Jim Gaffigan, too, to open things up, the comedian. And Stan has pink, so there'll be a couple different chances to show off your moves. I did sort of think that, nobody would care how I was dancing to Katy Perry because let's face it, everyone should dance to Katy Perry. And when it went on social media, I sort of rolled my eyes. But then I said, look, what are they going to get me for dancing to Katy Perry? You should dance to Katy Perry.
We should all have fun. Hey, look, this business is stressful enough.
Exactly.
Man. We're looking at you. We're like, hey, if that guy can have a good time, then you know what? We can all have a good time because you're the leader. You're the person that we depend on. You and an army of people at the NBA. There's so many people that work so hard every single day to advocate for our industry. And, I really commend you and the NBA for what you've done. And we're proud members and we'll continue to be. And
we sure appreciate that, Greg, because we're nothing without our members. That's the reason we get up out of bed every morning and work late before we go back to bed, is to make this industry better for our members, who in turn make it better for consumers. So I'm glad to hear that. Thank you.
Well, 3 weeks from today, on the 19th, we'll be in Vegas for the first full day. But of course, things kick off with Empower on Saturday, the 17th, and then Sunday, you'll be welcoming in the new CMBs, and there'll be some meetings going on then. So looking forward to seeing you, Bob. Appreciate your time very much. And thank you for being with me on One-on-One.
Pleased to do it, Greg. Thanks so much.
Pleasure. We'll see you again real soon. Have a great Monday, everybody. Bye-bye now.